If your pricing doesn't have some kind of consumption, some kind of usage metric tied to it, and it's like a subscription model, you've already been attacked and you don't even know it, or you're at risk going forward. Get your business model, the way you price, aligned with what AI is teaching your customers, which is I should pay for it as I use it.
Hi, I'm Chris Sugden, managing partner at Edison Partners and your host of Electrifying Growth. This is Sit Down with Sugden, where I share from my experiences as both the investor and an operator to help you get that next stage of growth.
One of the hot topics today is, job loss, fear of, reduction in force, as one term, an HR term would put it, because of AI. And you've got this kind of hot debate you see in some of the popular podcasts or the talking heads that are out there all the time, saying one person says, well, it's an excuse. AI is an excuse to reduce. I think actually Jack Dorsey sort of said that you're not being creative enough. And others took the exception and said the other way, which is, no, AI is going to create efficiencies. You ought to be able to do more with less. The answer is honestly somewhere in between. Number one, what are we seeing in our portfolio companies? We have not seen reductions created or fewer headcount created due to adoption of AI. What we are seeing is we don't have as much velocity in additions. How is that going to manifest itself as we roll this clock forward 1, 3, 5, and so on years in the future? To me, the relevant number is 1 to 5 years. We start to get out a decade. That's like way better than my crystal ball. But if I were to put a crystal ball on that's sort of a 1 to 5 year crystal ball, we're not going to see, in my opinion, in the very near term, huge reductions because of AI. I think what we were going to see is fewer jobs added to companies that have an existing AI strategy, because what I can do, Chris Sugden, and what one of my associates can do is sort of supercharged, at least if I'm doing it right. And, is one person, a young associate or analyst in a growth equity firm or PE firm, going to be the equivalent of 3, 4, or 5 people? That's TBD. Early results from us into what we do every day. We're not delivering software. We're looking for new investments. But as I think about it, I am seeing kind of in the work of outreach, speaking to a CEO about their business. That is a personal, we can't have a agent making a call and automating that. That's not going away. We now are looking at a deal and we're analyzing a SIM, a PPM, a PowerPoint deck, a business plan. Pretty amazing. We can throw a SIM in and get what would have taken 2 to 4 hours and get sort of a teardown of a company in minutes. And that's pretty powerful. So that's where I can see the productivity of an associate or senior associate going way up. So think front end, deal discovery, some reasoning, some interpersonal skills, some connecting of dots. I don't see anywhere in the near future, 5 years again, inside 5 years, that call becomes automated. Now we're hearing about digital twins, and I don't personally have an agent yet where the agent thinks and talks and speaks like me, and I'm on a podcast recording over here, another one over there with my agent. Maybe that happens. I'll put that in the maybe category. What isn't going to happen is replacing me, a senior associate, a VP, a principal, speaking to a CEO and really understanding their business. I just don't see that. And maybe that's obvious to many. Maybe someone who's really a believer disagrees. As I go over to software companies, the portfolio companies we invest in, sort of similar. Think about the sales function as deal origination, closing a deal. Quite frankly, I know there's some who think they can automate the heck out of the whole thing with an AI agent around selling. Maybe, and that's the similar analogy I'd make is to the long tail, where you can really have self-provisioning to a B2C customer or a long tail, a small business where you really can't afford to touch the customer. That's just economically not feasible. That becomes a much more efficient sale for sure with AI. Enterprise selling though, the $100, $500 million deal, I would be shocked if AI replaces any of that interpersonal relationship building, trust building sort of capability that salespeople have. Customer service, product development, engineering, huge upside for sure. And what's even interesting is finance and accounting, things that people don't think about, back office. That's becoming way more productive as well. Let's try and put some numbers on this sort of idea, what we're seeing. I think I said earlier something to the effect of one senior associate or associate might be the equivalent of two, if not three, relative to tearing down a SIM, running a model, et cetera. Putting that in our portfolio company's terms, what we're seeing in terms of early data is when it comes to product specs are fully written, I can tell Claude to write code to do something. That's also a 2 or 3 to 1 kind of engineering opportunity, if you will. Customer service, customer success is all over the board, all over the board. I've seen one company say call abandon rates have gone down by literally 90% or successful conclusion of a customer service call with AI. And I've seen others who are struggling. So again, a bit all over the market or all over the map relative to success with our companies and returns on investment. But it does go back to something I said earlier, where we are seeing success and significant returns on investment is those who kind of got in the game early and reassessed, didn't just sort of say, this is going to work and let's hope. Especially in the customer service and customer success side, we've seen some iterations where the first thing they thought of the calls that could be automated couldn't. And some other places they were able to lean in. As you sort of look at where we see deeper moats, and that seems to be an overused tech term these days, but for this audience, I'm hoping moat is something that might be even on the newer side. But where do we see things that are going to sustain less productivity and more areas for investment? I shared a little of this at our annual meeting as well, and there's some slides out there that you might find, in the open internet. But where are deeper moats? Data. Everyone's talking about data. Is it proprietary? Is it also proprietary to a point where I can actually use it publicly? In other words, so if it's consumer, think about healthcare data, that's got significant PII issues and you can't go use that data, but could it be anonymized to a point where the generalization of a big data set can power conclusions or recommendations? Seems a little bit obvious, but not LLM data sets, not large language models, proprietary data sets that are actionable for a specific industry, really interesting to us. Workflows that are in really complicated industries where you need, call it business or industry expertise, combined with, call it AI, is where we think some real magic can happen. Because the workflow requires sort of, in the old days, we used to call it like content expertise, like you knew the industry, so you were a content expert. That content expertise isn't being completely replaced by AI, but what is happening is the speed with which you can write the code, write the product, and get it in production is supercharged. But workflows, complicated workflows, are sustainable in our opinion relative to the future of AI. And then lastly, there was actually a pretty big paper written about payments, but I'm going to put in payments being at risk, which I completely disagree with, but payments, regulatory, and compliance. Think about moving money, how much trust is involved in moving money. Think about highly regulated industries or where compliance in industry is really important. AI will be an enabler, will not be a replacer, in my opinion. And there, like I said, there was a pretty big paper where all the payment stocks in the public markets got hit pretty hard because AI was going to replace, Claude was going to replace all payments. I just don't see it. There's way too much money being moved and way too much oversight being needed. What is likely to happen, however, is the number of people doing the double checking, doing the proving, doing the reconciling, that will be fewer people required, but you'll still see human oversight in there. But even more importantly, in payments and regulated industries, I think you'll see software meets AI in a business model that will be sustaining. The last thing I'd comment on, and it's certainly not the last on AI, because AI is going to be this ongoing conversation we'll keep having here over months, if not years to come, but business models. I think the biggest change that I'm sometimes accused of in my own shop of making these declarative statements, always and nevers, aren't good in debates because there's always an exception. But I think the game on pricing has changed and it isn't going back. And this is worthy of a whole separate podcast on it, but I want to leave this, give folks to think about in your business. Think about how you're consuming your favorite Claude or ChatGPT agent as your friend that's answering your questions. These agents are all trying to be our friends now, which can be annoying or fun depending on your perspective. But how do you consume? How do you pay for that? You've got this monthly subscription, I get it, but are we heading towards now usage and tokens? And now, if you'd like to continue with your queries, I think about the pinball machine. I date myself, the video game arcade, put some more quarters in. That's what these agents have now taught us to do. And both Claude and OpenAI have to justify their valuations. they have to have us in consumption mode. Think about it on the enterprise, the B2B side of where AI is going, especially these larger kind of LLMs and agents. Consumption is not going to stop, I guess is the best way to put it. The SaaS model where it's a annual subscription fee, set it and forget it. A lot of conversation on this topic around valuations as well, but I'll say valuation for another day. I say for those who are entrepreneurs and those who are company builders, if your pricing doesn't have some kind of consumption, some kind of usage metric tied to it, and it's like a subscription model, I think you're going to either you're already been attacked and you don't even know it, or you're at risk going forward. So get your business model, the way you price, aligned with what AI is teaching your customers, which is I should pay for it as I use it. And the beauty of SaaS was subscription, raise prices. It was almost like this growth annuity. And that's why valuations have come under attack. But if you're an entrepreneur, you're a business builder out there, you're one of the Edison CEOs, you've heard me say this already. But I do believe, I'll go back to my payments days, and I was talking about payments a minute ago, but payments had it right because they were a transaction model. You had a fee that was associated with an action, and everyone kind of goes, oh, that was a good trade. Think about what SaaS has done. I'm paying this annual fee, and am I angry I'll pick on Salesforce. Am I angry I'm paying Salesforce this much money, and am I feel like I'm getting the value? So how do I make it become much more of a consumption or usage-based model? And not to so much pick on Salesforce, I'll give them some credit too. They seem to be pivoting or adopting pretty quick. Even in the last 3 to 6 months, a lot of things Benioff and his team have done, we're reacting to those of us who are Salesforce users not being very happy about their AI capability or their AI business model. So you are seeing even big companies adjust quickly to pricing, and pricing probably worth that whole sit down with Sugden session. But I would say consumption models, aligning your customers' usage, their value they're getting to how you're pricing, that ship has already sailed. It's moving even faster if you want to kind of stay with that analogy of a ship, but it's going faster across the ocean and it isn't turning back. So if you want to be on it and moving, and you're sitting on a subscription pricing model and you haven't really thought about how that can become consumption, get on it. And I would say one of the things we see in our company is a subscription plus, where it's like there's a base fee and there's a consumption on top of it. That's a way to get a little bit of maybe the best of SaaS meets an AI model, but pricing is materially changing before our eyes. And in some ways, that's where you are a little late if you're not already sort of trying to figure out how your customers will consume in the age of AI.
Thank you for joining this episode of Electrifying Growth. For more resources, inspiration, and a look inside the Edison Partners network, sign up for our newsletter at www.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.